Mayuresh Joshi is now joining us this afternoon. Mayuresh, what should an investor do in such a wild swinging market? Should he just buy the names that he likes and sit when they fall, or essentially just be out of the market?
Afternoon, Pankaj. I think it really depends on the risk profile of every investor. But clearly, I think if one really has a longer time horizon of more than 18 months, 24 months, any sharp falls that probably come to the market, I think it becomes very, very difficult at that point of time because one really assumes that the markets might correct further. But again, I think as I've been mentioning time and again, I think the volatility in the markets might continue because of both domestic and global factors, crude included, in the way the crude pricing is behaving. Clearly, I think investors with a long-term horizon should be taking qualitative calls, a stock-specific approach, and also putting in money, just a proportion of it. So 15-20% probably allocated at this point of time, and that too in a staggered fashion.
Right. But with such wild swings, trading in the market should clearly be avoided.
So again, clearly, I don't look at trading. In such a volatile time, I think it's very difficult to preempt market moves. So clearly, I think the volatility in the markets would keep traders on their toes, and that is what precisely has happened today. I think with the sharp cash that we saw, the correction was equally sharp. So I think traders would have got caught on the wrong foot on both occasions today.
Right. How would you look at 7,500, 7,580 where we are trading? It's a decent level. A little bit of earnings miss is now factored in.
Yes, to a large extent, Pankaj, I think soft numbers are expected for this quarter and next. Couple that up with the slowdown in capex recovery is expected for at least 2 to 3 quarters. So clear markets are probably just stating that. But once core numbers start coming out, I think the markets react to those stocks respectively. So clearly, I think if you take a sector bias, some sectors are expected to do extremely poorly over the next 2 quarters. Within those sectors, I think if a few stocks underperform, I think you'll see a lot of beating taken place on these stocks. Clearly, if some stocks outperform estimates, you'll probably see some revival happening within those sectors. So clearly, I think it's going to be a stock specific market even when it comes to results. But largely, I think soft numbers gestated in the market. To what tune will the market react on a holistic base is more to do with what happens globally. So I think the Chinese data points, which nobody's really sure about, what happens with crude, I think these are the determining factors along with the softness that one really expects on the domestic side when it comes to earnings.
Right. How would you look at TCS and the numbers over there?
The numbers did disappoint, and again, I think it was below what the analyst had probably estimated in terms of top line, though I think bottom line and the EBITDA margins came more or less in line with estimates. Again, I think it's the key verticals that TCS caters to. I think energy, telecom, you're probably looking at retail, healthcare. I think you need to see sustenance happening in terms of client budget spendings actually stabilizing or going up, which will be decided in this quarter. So clearly, I think there has been a miss in terms of how the top line for the company has grown. It has largely underperformed its peer Infosys over the past 3 quarters. Again, I think because of the unfortunate incidents in Chennai, I think a lot of IT companies will take that hit in terms of margins, and you're obviously seeing headwinds in terms of cross-currency fluctuations. Having said that, probably I think the valuations of TCS at the current juncture, the premium between Infosys and TCS has actually narrowed down quite significantly. And clearly, if one looks at the order book that TCS is sitting on, if one looks at the expectations that the management has in terms of utilization levels stabilizing, add to that, I think the earnings expected to go up from FY17 in constant currency terms, one really can assume that any decline from the current levels, I think becomes a good opportunity. But again, I think with the revenue misses that we've probably seen, we are lowering our EPS estimates from an FY17 perspective for TCS.
Right, but when we are talking about TCS, the premium valuations were 22 times forward earnings. Now it's trading at 16 times forward earnings with a low growth assumption. You think it's slowly and steadily getting into the value zone?
Well, yes, as I mentioned earlier, I think the derating probably in terms of comparison with Infosys over the last 3 quarters has been playing out on the stock. So if you talk in constant currency terms, Infosys in the quarter gone by has grown at 6.9%, TCS grew at 3.9%. In the quarter before that, Infosys grew 4.4%, TCS grew 3.5%. So clearly, I think the underperformance that TCS has reflected in comparison with Infosys is very much there. The premium valuations that TCS got in comparison to Infosys has actually got narrowed down. Again, based on the factual assumptions of revenue probably coming down, lesser than what analysts had expected, And clearly, I think there have been some execution issues, both in terms of how the Indian business has been moving, how diligent has been panning out for Infosys, for TCS, sorry, and probably how the digital business is expected to grow. So clearly at 16 times, 16.1 times forward earnings, it is attractively placed. But again, I think there might be further corrections onto the stock. The softness might be expected. But as I said, I think these corrections probably give a good opportunity for long-term investors to actually look at a stock like TCS.
Right. Infosys, say if they declare good set of numbers tomorrow, the shift which is going on between TCS to Infosys for the last 2 quarters, will that continue?
It might continue, and clearly I think Infosys has embarked on quite a reasonable kind of a growth chart. So having said that, I think if you look at, as I mentioned earlier, in terms of cross-currency growth, I think that has been quite stupendous for Infosys. Again, I think the client mining activities, the new order wins have probably been far better compared to its peers, and again on its own historical averages. So clearly I think the expectations a little bit low this time around for Infosys as well, both in terms of dollar revenue growth. In fact, it might degrow in this quarter on a quarter-on-quarter basis, and even on a constant currency term. And again, I think the points that might act as tailwinds for Infosys might be increase in utilization levels, where the management says that 250-300 pips is a gap that they probably can be perceived in terms of improvement happening over the next few years. And clearly, I think in terms of their guidance that has been given out, I think they should be able to meet their guidance at least for this year. And again, I think as I mentioned earlier, for the top tier IT names, I think the kind of businesses that they are in, and again, I think the kind of mining activities that they've done, you probably would expect a decent amount of constant currency growth happening in FY17. So yes, I think we remain optimistic on Infosys as well within the top tier bank.
Right. So, Infosys, if we look at the, valuation difference now, it's about 8-10% now. Do you expect Infosys to go at a premium, or do you think that both of these names would trade probably, at similar valuations till the time Infosys again becomes a leader in the EBIT margins?
No, clearly, I think Infosys has shown signs of tremendous growth, and that is clearly reflected in the numbers. Now, whether Infosys becomes a bellwether of the IT industry again, I think the numbers should do the talking, Pankaj, for that. So clearly, I think going by historical records and going by assumptions that they will probably grow at a decent clip over the next few quarters, one really assumes the valuations for Infosys and TCS to be at par over the next few quarters. Now, it's only after a few quarters that one really can assume or lay that assumption that Infosys can actually lead the IT bandwagon. But again, I think TCS has exhibited strong growth. It might be struggling in the past few quarters, but in my opinion, I think over the next few quarters, TCS should be able to get its growth momentum back.
Right. Let's talk about the other name, IndusInd Bank, which declared numbers. What do you make of the numbers? Steady as ever?
Oh, yes, absolutely. And again, I think the market probably assumes that asset quality will remain stable, though there might be a little bit of a blip in terms of the absolute numbers that came through. Strong management commentary. Again, I think the credit cost extremely low. The return on assets around 2%. Return on equity around 18%. You've got best of the industry class return ratios in case of IndusInd Bank. The expansion plans very much on track, and again I think the CV business, which had shown signs of improvement, still seeing signs of improvement happening on that front. The non-interest income also showed a significant amount of growth in the quarter gone by. It's only the valuations with current CASA at around 34-35 times, around 2.9 times price to book, 3 times price to book. A little bit on the higher side in my opinion. But again, I think not ruling out a stable performance, still expecting decent growth to come through for the banks, and we're still expecting decent earnings momentum to be maintained over the next few quarters. So it's a clear hold from our side when it comes to IndusInd Bank.
Right. As far as IndusInd Bank is concerned, do you think you would say it's priced to perfection, it doesn't see selling, and that's why opportunities after correction into the other banking names are better?
So clearly, I think it has been a consistent performer, Pankaj, and if you take any quarter over the past so many years, it is not disappointed in terms of what the management has envisaged and what actually comes out in terms of numbers. So on any account, whether it's asset quality, whether it's NII growth, whether it's the advances growth, and whether you're talking about how their credit costs are panning out, I think all these parameters are playing extremely well for the bank. To top that up, I think extremely well capitalized. So I think all the factors work in for IndusInd Bank probably works to perfection. So I think the only caveat here is that if it disappoints in either of the quarters to come, I think there might be a huge amount of disappointment to the stock, which actually gives us the prognosis that the other banks probably which have not done well or which are not doing well, if there is a recovery probably happening through both in credit cycle coming through the next few quarters, and again I think the capex recovery coming through, which eases the end working constraints for a lot of industries that these banks have lent to. I think the earnings recovery for a lot of the other banks which are catering to a lot other industries apart from the CV industries, which has a dominance in IndusInd's portfolio, might actually start faring well. Whether they're doing that at this point of time, very sticky and contentious. So clearly I think there is scope in the larger private sector banks, but IndusInd, again as I said, has been a consistent performer, and in my opinion I think the management commentary was extremely strong and positive.
Do you think a retail-focused bank would continue to do well? So IndusInd is still better placed than probably an Axis and ICICI because of the overall portfolio or the loan mix that they have?
Oh yes, and again if you look at the granularity of how the lending book is positioned, I think any bank which probably has a greater presence towards the retail side is expected to do well, with consumption expected to drive earnings for a lot of these banks and the end user industries as well. Having said that, probably I think even the focus of the larger private sector banks has clearly moved towards the retail franchise. So I think if you look at ICICI Bank, Axis Bank, a major portion over the past few quarters in terms of incremental lending probably has happened because of the retail book. So clearly I think the banks are focused on the retail side of things, though I think you must take into cognizance that whatever lending has happened even on the corporate side, I think once these pressures start coming off, the earnings on the base of FY17 or FY16 will start appearing far much better.
Do you think PSU banking names have any value with the prices the way they are correcting, or still the NPA issues are huge and prices can correct further, or at least there is no upside in the near term?
No, clearly I think valuations have always been attractive in the case of PSU banks. It was only the issues related to asset quality and how the banks were probably treating them that was probably letting them down. So clearly I think one really is not sure on how the asset quality might actually pan out for a lot of these PSU banks. Though we've seen very stable set of numbers except a few of the PSU banks in the quarter gone by, we've actually seen asset quality stabilize. But clearly with the RBI directive in terms of cleaning up of bank balance sheets over the next few quarters and months, I think you might see some amount of additional stress from the restructured pipeline actually coming and playing out on the balance sheets of a lot of these PSU banks. So one really needs to understand how numbers will stack up in the quarter gone by. And even when numbers do come out, I think one really needs to do a detailed analysis on what expectations are basically getting laid out from management commentaries over the next 2 to 3 quarters. So the central point for a lot of these PSU banks re-rating would be asset quality pressures probably coming down, and for a select few, I think how capitalization takes place.
Right. As far as some of the infrastructure names are concerned, names like L&T, BHEL, they have corrected quite a bit. Do they give any valuation comfort, or as things are not picking up, the IIP data that we got yesterday just suggests that EPS cuts would come in and valuations would again start to look expensive?
Again, I think IIP data has to be seen in a very holistic fashion, Pankaj. So clearly, I think if one takes into account the value effect and the base effect, add to that, I think the Chennai flood situation, I think the number would not have come so soft. So clearly, I think the softness in the capital goods industry does continue. I think you're probably seeing weaker execution taking place, which is definitely playing and taking a toll on the EBITDA margins. Couple that up with orders not coming through thick and fast, and even if orders are coming through, I think you've still got the issues of net working capital constraints playing on balance sheets like L&T and BHEL. Having said that, probably I think within the sectors that they cater to, I think you still need to have a huge amount of traction for the end industry. So for BHEL, I think a lot is getting gestated into how execution has been very weak, what kind of order flows will come through, if they come through, I think at what level the execution will happen. For L&T, more or less with energy prices staying soft, what probably happens with hydrocarbons as a business, couple that up with metallurgical and the material handling business not doing well on the EBITDA front. So clearly you've got individual pockets which are probably having pain points, and those pain points might still carry through the next couple of quarters. But again, in our opinion, again, L&T is a stable stock, it's a very qualitative stock, it probably has gone through the grind. If it corrects further, our take is that some allocation, at least partially, and in small quantities should start getting allocated towards L&T, and it's an entire play in our opinion on the capex recovery theme. And once that happens over the next few quarters, I think L&T will be a key beneficiary along with the non-core asset sales that the company and the management is intending to do.
Right. Also, some of the other infrastructure companies, maybe the second tier ones, names like Crompton, some of the other ones. Do you like those names, or do you think one should stick to the tried and tested name like L&T?
I think from the large caps, L&T remains one of our preferred choices, more or less to do with the valuation comfort that one is getting even at the current juncture after the sharp decline that you've probably seen on the stock. Within the mid-tier names, probably I think our take is that Crompton is expected to do well. But again, I think the consumer durables business will hold up in terms of EBITDA and bottom line growth. It's the main core business that might still struggle for Crompton. So I think it might be a mixed set of numbers on the consolidated side. So I think Inox Wind is something as an offshoot that we're probably liking in the capital goods theme. And even something like a Voltus or a Blue Star or declines, where our belief is that the earnings for both these companies should be relatively better over the next couple of years.
Right. As far as aviation pack is concerned, do you think things have changed over there and markets are yet to capture in the best? Crude is going down every day. Traffic worldwide is increasing.
No, clearly, I think all this is getting gestated, right? And the stock prices are reflecting the same. So I think if ATF prices stay low, you're probably going to see an expansion happening on the EBITDA front, and that margin expansion will probably trickle down onto the bottom line. Having said that, probably traffic growth is expected to go up, and next 2 quarters, as I've been maintaining my stance, I think these stocks are expected to perform well. So again, it's a clear hold on Interglobe Aviation. And yes, I think the stocks have done exceedingly well is a point to be understood by a lot of investors who are probably watching the channel right now.
Right, but you would still be buyers into these names, or you would wait for a correction?
No, again, as I said, I think the core balance sheet dynamics are still weak for companies like Jet and SpiceJet. SpiceJet has a lot more payments to be done in terms of regulatory issues. So a lot more has changed for SpiceJet over the last 4 quarters in terms of both the flight increases happening, the cost optimization probably happening through. That has reflected positively in market share gains. But even on an EV EBITDA basis, I think Jet and SpiceJet probably a little bit more on the higher side. Interglobe Aviation as well, because of their clear leadership position in terms of market share, because of their profitability, because of the model that they probably possess, is in a much better state. But again, at this levels, I think I'll not be putting fresh money. So anybody holding on to a stock like Interglobe at lower levels should continue to hold it.
Right. Mayuresh, thank you so much for taking out time for us. Always a pleasure.